How many range of points classify as small or big? Gap up or gap down in a stock index. Gap up and gap down in stock markets. A gap in the stock market occurs when the price of an index or a stock opens significantly higher or lower than its previous day's closing price. This creates a gap in the price chart. Here's a breakdown of gap up and gap down, their classifications, and how they are interpreted. 1. What is a gap up? A gap up occurs when the opening price of an index or stock is higher than its previous closing price. Example: if a stock closes at 100 and opens at 105, it is a 5-point gap up. 2. What is a gap down? A gap down occurs when the opening price of an index or stock is lower than its previous closing price. Plus D. Example: if a stock closes at 100 and opens at 95, it is a 5-point gap down. 3. Types of gaps. Gaps are typically classified based on their magnitude and significance. A. Small gap up or gap down. Definition: minor price movement between the previous close and the current open. Index points. Small gap up, 0.5% to 1% above the previous close. Small gap down, 0.5% to 1% below the previous close. Impact. Often caused by minor after-hours news, small changes in sentiment, or regular market movements. Example: in the Nifty 50, a 50, 100-point movement out of approximately 20,000 points might be considered small. B. Big gap up or big gap down. Definition: significant price movement at the open. Index points. Big gap up. Greater than 1%, 2% above the previous close. Big gap down, greater than 1%, 2% below the previous close. Impact. Often results from major economic announcements, corporate news, or geopolitical events. That's example: a 300, 500-point gap in Nifty 50 would be a big gap up or down. 4. Causes of gaps. Gap up causes: positive earnings. Reports better than expected corporate profits. Economic data. Favorable GDP growth, reduced unemployment, etc. Global cues, bullish trends in global markets. For example, the S&P 500 rising sharply. Mergers, acquisitions. News about a company being acquired at a premium price. Upgraded outlook. Improved ratings from analysts. Gap down causes. Negative earnings reports. Missed earnings or weak forecasts. Economic data. Unfavorable reports. For example, inflation, interest rate hikes. Global cues. Bearish trends in global markets. For example, Dow Jones falling overnight. Downgraded outlook. Analyst downgrades or negative sentiment. 5. Implications of gaps. 𝐂. Trading gaps. Continuation gap indicates a continuation of the trend, uptrend or downtrend. 𝐂. Example: in a strong bull market, a gap up signals further buying. Exhaustion gap signals the end of a trend, often seen near market tops or bottoms. Example: after a prolonged rally, a big gap up may indicate a reversal. Gap filling. Markets often fill the gap, meaning the price retraces to cover the difference created by the gap. Reasons: profit-taking, market corrections, or overreaction to news. Time frame: the gap may fill within the same day, weeks, or months. 6. Gap trading strategies. For gap up, borrow. Buy the strength. If the gap up continues with high volume, sell the weakness if the gap fails and retraces below key support levels. For gap down, short the weakness if the gap down breaks key support levels. Buy the strength if the gap reverses and the stock index shows recovery. 7. Key points for major indices like Nifty, S&P 500, or Dow Jones. Small gaps within 0.5%-1% are typically insignificant in high-volume indices. Big gaps, 1% or more, often signify significant news and can shape the market trend for the day. In highly volatile periods, even larger gaps, 2% to 3%, can be observed. Understanding gaps is critical for short-term traders and long-term investors to anticipate market trends and price behavior. There are more videos and playlists if you would like to deeper dive into any points. Please check it out.